All right. Assalamu alaikum and good afternoon, everybody. Um, so let's get started. Right now there are 19 participants there, 21 including me. Um, okay. All right. And I have, uh, checked your assignments and have given it back to you along with my remarks and the marks as well. All right. So if you have any issue regarding your assignment, that if you are not clear why your marks were deducted, you can discuss it with me later in the class, right? So this is how we'll go about it. And those who are not submitting their assignments, they will be. Uh, I keep on saying, you know that. So that is one of the problem you may face. All right. So let's start now. Let me see. Okay, still the students they are coming in, but it's almost that. It's, yes, it's the time. So now I won't admit anybody. All right. So now, yes, it makes it 23. Fine, let me take a screenshot as well that who is present actually and who is not. Because I am sending just a minute. All right. So now let's start. Now, Momna, you just joined. I just admitted Momna, and I can, yeah. So now you are there. Fine. All right. Now let's. Now the students they are joining late. I told them that I cannot enter you after that time, but still they are joining. So this is strange. So now I won't let them in. Azhar, you are late. Okay, I still admitted you. So be careful next time. Okay, and let me mark because I need to take a screenshot as well to see who is present and who is not. All right. Now, okay, you know that in the last class we talked about sources of finance, especially internal and external sources of finance. You know that. Okay, and you can see the screen as well. I have shared it. Busy हूँ. All right. Can you hear me now? Because I just got a phone call. I don't know why. Okay. All right. So yeah. Can you hear me now?
Yes, sir.
All right. Okay. Chande Faryal. Okay. Thank you. Now, so now I told you earlier that we discussed about internal and external sources of finance, right? And I actually shared a video with you regarding venture capital. And I told you that I would ask questions from you regarding that video as well. So let me ask few of you about it. Uh, who can explain me that? Um, yes, Hamza Amin, can you tell me what was that video all about?
Yes, sir. Sir, so basically, there was an entrepreneur who made a device Marx made, and the purpose was to allow teachers to make notes and give personal feedback to the students. And with that device, he was able to mark 30 books in 30 minutes. So that basically saved the time. And there were total five investors, and he wanted to take investment from one of them. So four of them rejected his idea, but only one was interested.
Okay,
And
all
at
right,
the end
good.
of the
Yeah, yeah,
video,
that yeah, that's right. But now the thing is,
yes,
Hamza, very good that you actually watched it very closely. Actually, those people who were actually sitting right in front of that person who actually brought that new innovative idea. Okay,
yes,
those who actually those who have not watched the video, they will not have any clue what we are talking about because I did share that. So you were responsible to watch that. Now, actually, those people who were actually sitting in right in front of that person, they were actually they are multi-billionaires. They are business tycoons, I am telling you. Okay. And because they are already running many businesses in various parts of the world, now they have no intention to start their business on their own. Now they want to take the benefit of someone's idea. Okay. And they are there because they have lots of money. They are willing to spend it, but they do not want to start it on their own because you know that you have to take lots of pains, you have to spend more time as well, huge responsibility to run the business. So now they think it's the time to invest money whatever they earned because they are multi-billionaires. So we call them venture capitalists, those people who provide the capital for a new business which may involve risk as well because it's a new business, so it means people may like it or may not like it. That person may not get finance from traditional sources such as banks. Okay, now because the person was there and some of the candidates they raised some questions and then they said that we are not interested. So finally, one person was there and he actually gave the offer that okay, I will give you all the money you needed earlier and whatever the money actually I do not remember what amount he actually
sir,
asked
twenty
for,
thousand
but
pounds.
20,000 pounds. Okay, all right, good.
Yes,
So that person said that okay, I'll give you all the money, but I want 50% share in the profit. Now, without doing anything, the idea belongs to that person. That person will manage it, okay, but 50% profit will go to that businessman. Now that person did not agree in that video. Why? Because he thought that maybe because that was my unique idea and how would I give 50% of my profit to that person? Then later on the person realized it as well, and then he actually gave a much attractive offer to that person, and he said okay, I will have 35% of the profit. Okay, and if I as soon as I get my money back, let's say it was $20,000, and let's say if the person gets the money back, then that share goes down to 30% from 35. So the person liked the idea that okay, 65% will be the initial profit I earn, and then my profit percentage will go to 70%. So the person accepted that offer. So it means those businessmen who were interested in the idea, at least they listen to that person. They have huge amount of experience of running the businesses. So though they know exactly whether the business is going to be successful or not. Nobody actually all praised that idea. I told you earlier, but somebody actually posed a question as well. Okay, in fact, criticized it, said that this is easily copyable. In the video, one of the business tycoons said that it is easily copyable. So it means that the idea may not remain unique for a longer time period. So that was one of the point on which he actually did not offer anything to that person. So it means when, so you can get, as a businessman you can get capital from those people as well. Okay, and they invest because they know whether the business will be successful or not using their past experience. Banks cannot do it. Why? Because banks, they only see the current performance of the business, or maybe whatever happening in the current market. Okay. Otherwise, they will hesitate to lend money to a new business. But venture capitalists, they are always ready. Why? Because they have always taken risk, and that is why they have reached to that point. Now they are multi-billionaires, and they have taken risk. That's why, because I told you earlier, greater the risk, greater will be the profit. This is the case. You know that, right? So they are there, and it means it is available to those new businesses as well who actually come up with new or innovative ideas. So now I think you know about what is venture capital, and it's not that difficult when traditional sources of finances are not available. But I told you that the problem is now you have to share the profit with that person as well. Okay, that is the issue which is there, and all management, all responsibilities belong to you. That person won't be doing anything. So, all right, moving onwards. Any question regarding venture capital from any of you who is still not clear about it? I'm waiting. So there is no question. All right, so we can move forward. All right, that's great. Next is, now sources of finance. We have discussed that sources of finance can be identified, either they are generated from within the sources, that is what we call internal sources of finance, or they are being generated from the sources outside the business, and we call them external sources of finance. We have discussed it. Now we can categorize the sources of finance on the basis of time as well, the time period. Either it is short term finance, as you can see that the short term finance is which is available to a business for up to 3 years. Okay, bank overdraft, you know that we have discussed it, but it actually is an external source of finance as well, and a short term source of finance as well, because bank overdraft facility is always given for a few months or maximum of 1 year, not more than that. And short term finance is up to 3 years. Trade credit, again, you know what is it, and again, you cannot actually offer your customer more than 3 or 4 months time period to pay back. Like customers buy from you, and you tell them, okay, you can pay after 3 months or 4 months. This is not this is possible, but can you give them too long a credit period like 1 year or 2 years or even more than 3 years? This is not possible, na? So this is again an external source of finance as well as a short term source of finance. Same is the case with debt factoring as well. Now, debt factoring, we discussed it in detail, right? So it is also whenever you are supposed to get money from a person after a certain time period, and you require cash immediately, you contact the agency, specialized agency. But again, this is only possible if the money is going to be collected within few months time period. Again, you cannot actually go to an agency and say that, all right, after 6 months, or after a year or 2 years or 3 years or even more than 3 years, you can collect the money from the person. This is not possible. So you understand, I'm not going to talk about its advantages and disadvantages because we have already discussed it in external source of finance, because all three are part of external source of finance as well. Then we have medium term finance. Again, this is from 3 to 10 years. Okay, from 3 to 10. Okay, and what does it mean? It means you can use the finance from 3 to 10 years. Business is supposed to pay it back within 10 years time, within 10 years time, right? So when you think about hire purchase or leasing, you lease a car, and you know that generally the cars can be leased for either 5 years or 7 years, not more than that. You know that. Okay, and even you cannot lease a car for 2 years or 3 years. This is not possible. Bank won't allow you to do it. So either 5 or 7. So again, it is between 3 to 10 years. So this is medium term finance, and I discussed in detail about hire purchase and leasing in the previous class as well. And hire purchase and leasing is also an external source of finance, but it is also a medium term source of finance as well. Okay, Bilal Jamil, are you clear about hire purchase and leasing?
Yes, sir.
All right. Then the third is long term finance. This finance is available for more than 10 years. That the business is supposed to pay it back after 10 years. So it includes long term bank loans, debentures or bonds, sale of shares. We have discussed all of those sources as well. You know that. Okay. And these, now, if you think about starting from short term finance, bank overdraft, trade credit, debt factoring, then medium term finance, hire purchase and leasing, long term finance, long term loans from banks, debentures or bonds, sales of shares. These all are external sources of finance. So generally, when we talk about the there can be other sources of finance which can come in it as well. Do you know what? Like if I talk about um, why they are external, because you have to pay it back. So obviously, only external sources of finance, they require the money back. Otherwise, in internal source of finance, you do not need to pay it back now because it's your own money. That is why all external sources of finance are part of this category. Either it is short term, medium term, or long term. So short term is up to 3 years, medium term is from 3 to 10, and long term is more than 10 years. Now, any question regarding it?
Sir,
People are
can you
most
please explain bank overdraft again?
Yeah, okay. Actually, I did not explain bank overdraft because we discussed that in the earlier class, so I explained there. Okay, I can explain here. Sorry. Bank overdraft is a facility given by the bank to its existing account holders. And what is that facility? For example, an account holder is having $10,000 in the account. Okay, and the bank allows the account holder to withdraw more than $10,000. Let's say $12,000. They say you can um, use or withdraw $12,000 instead of $10,000. So that $2,000, which is over and above the amount which is actually there in the account, that will be called overdraft. And that $2,000 will be later paid by the account holder to the bank. Got it, Amin?
All right. Yes, sir. Got it.
Okay. Okay. Any other question?
No,
I'm
sir.
waiting. All right. Okay. Anybody else? Sorry. Eh, no other student? All right. Okay. Moving onwards. Factors influencing the source of finance. Like while choosing a source of finance, either it is internal or external, or it is short term, medium term, or long term. What are those factors which actually affect your decision, right? While choosing a source of finance. One is time period. Now, for what time period you need that amount of finance. Let's say if you cannot pay it quickly, then obviously you will go for long term source of finance. Like for example, you want to raise a certain amount of finance to set up your factory. Now you know that when you will set up your factory, it will take time. You will install machinery, you will hire workers, you will buy raw material, and after some time, you might be able to start your business. Okay, you will be able to sell your products as well. Okay, so it will take time. So you might go for medium term source of finance or long term source of finance because you might not be in a position to pay it back within a year or 2 years or 3 years time. So short term finance might not be a suitable option. Similarly, if I talk about house building, again, you know that yes, loan is available for house building as well, and again, it is for more than 10 years. And long-term source of finance is used for that as well because it's easier for you to pay it back in installments over a long period of time. But if the time period for which you require the amount of finance is short, like for example, right now you are having problem paying your supplier, because right now you do not have ready cash, and customers are supposed to pay you back after 3 months, but you require cash right now. So you can go for short-term source of finance. You can immediately get an overdraft facility from the bank, and you can pay your supplier so that your production can continue, right? So, and but you know that after 2 months, your customers will pay you the amount, and then you will pay the amount back to the bank. So, in that case, because you require money for a short time period, so you will go for short-term source of finance in that case. Then cost. Sorry, again, you need to see that what amount of cost involved in using that source of finance. Like for example, if I say the interest is very high, okay, in a country, so if you go for a bank loan, you might have to pay a higher interest rate. Interest is an expense, it's a cost for the business, and it reduces the profit of the business. So if interest rate is high, you won't go for a bank loan, right? Because it will increase your cost. So you might go for some other cheaper source of finance where not much cost is involved. So you may go for either internal source of finance because there is no cost involved there, you know. So this is how you can do it. Then amount required, yes. Whether the amount you require is a big one or a smaller one. If it is a big one, then you can go for either external source of finance or long-term source of finance because it is available for 10 years. So you need to understand, in short-term source of finance, small amount can be raised. In medium-term source of finance, relatively large amount can be raised, and in long-term source of finance, you can large a huge amount because you have to pay it back after a long time. So it's easier to pay it back, and the lender does not bother about it because lender knows that you have to pay it in a long time period, so you will be able to pay it because the big amount will not be paid all of a sudden. It will be paid in installments, in small amounts. So amount required, if it is, let's say your plan is to take over another business. Okay, now taking over or buying another business requires a huge amount. For that, you may go for long-term source of finance or external source of finance, right? But if you require cash for meeting your daily expenses, okay, so for that, like payment of wages to workers, you can go for short-term source of finance. In that case, you can use your retained profit. You can use a bank overdraft as well. So this is, you can sell your idle assets which are available, which are lying idle. So you can use that depending upon how much amount which is required. Then risk involved in the project. Now, if project is more, for example, you are investing in a new project, let's say in a new business or in a new product. Let's say you are going to develop a new product, okay, and because it's new, so risk is involved. So if it is highly risky, you won't go for external source of finance. Do you know why? Because if it is, for example, if the project faces a loss, then you have to pay the whole amount to the bank, okay, because you use external source of finance, and in order to pay it back, in that effort, the business might end up closing down because they might not be able to pay it back. So it is better to use your own source of finance, that is internal source, because that would be your own money. And if you lose that money, still you do not have to pay it back in that case. Then we have gearing ratio. You need to understand. We need to see the gearing ratio as well. Now, gearing is actually, what does it tell? Let me just explain you that. Just a minute. What is gearing ratio? Let me write it there. Although we will study the chapter which is related with accounting ratios, but here I need to tell you about this particular ratio because it is relevant. Okay, now gearing ratio, first of all, let's see the formula. The formula is long-term loan divided by total capital, just total capital into 100. Now this is the formula. Now what does it mean? It means, for example, there is a business, okay, and that business has a certain amount of capital, okay, but out of that, let's say whatever the capital is, long-term loan, let's say it is $10,000, the total capital which is available with the business. Out of $10,000, $6,000 was raised from loan. Okay, you borrowed it from the bank, right? And total is how much? 10,000 into 100, because there are two ways to raise a certain amount of capital. One, either to go for external source, you know that, if I talk about capital, or by selling your shares. We discussed it in the previous chapters as well. You, as a company, you can sell your shares and you can get money from shareholders. That is your share capital, or you can borrow money from the bank, that we call loan capital, right? And we call it long-term loan. So now it means, what will be the answer? The answer will be 60%. Now, I'll say that business is highly geared. Now, what does it mean when I say that? When I say business is highly geared, that means business is highly risky. Why? Because more than 50% of the capital has been raised from external source of finance, that is long-term loan. So if, let's say, you have to pay it back after some time period, more than 50% of the capital will be taken away from the business to pay it back. So obviously then business will not be left with enough capital to continue its activity. So that is why, for example, if this is the case, then business will not be using external source of finance any longer. Why? Because right now the business is highly geared or risky. Okay. But if this is the case, let's say if only 2000 has been raised through long-term loan and rest the total amount is 10,000. Now the gearing is how much? It will be 20%. So it means whatever the capital business has, only 20% of the capital has been raised through external source of finance. So that is a very small amount. So it means if this is the case, business can use that option. That is the external source of finance. Business can go for that. But even if the the gearing ratio is 40%, even even this is not recommended that the business should go for external source of finance. Do you know why? Because right now it is less than 50%. Okay, but when they will borrow money from the bank, obviously the 40% may reach to 50 or more than that. That is why then it may not be suitable to use external source of finance. Otherwise, if gearing is low, it's not highly geared. So in this case, when there was 20%, we say low gearing. Here business can use external source of finance. All right. Any question regarding gearing? No question?
Sir, what is meant by non-current liabilities?
Non-current liabilities are also called long-term liabilities, and they are paid after 1 year. So it means when I say long-term loan, it is a non-current liability. Why? Because you have to pay it after a year as a business. That's it.
सर
Got
जो
it?
फॉर्मूला में से हम यूज कर सकते हैं ना
Yes, you
gearing
can
ratio
use
के
it.
लिए
Like, yes. Like if you want to use instead of long-term loan, you can use here non-current liability. Yes, that's right. I can write it there. Non-current liability. Yes, you can use it.
ठीक है सर
So that's, yeah, okay. Okay, although we are yet to cover the accounting portion of this subject, but yes, because you asked it, so I explained you that. All right, moving onwards. Now, so it means gearing ratio will be considered before choosing a source of finance. Then we have size of business. Obviously, if a business size is small, you might require a small amount. You might not need much capital to support your business activities. So you can go for short-term source of finance or internal source of finance. But if business is large, you know that large businesses usually have large expenditures as well. So then the business might go for long-term source of finance or external source of finance. Legal structure, again, you need to understand whether the business is a sole trader, partnership, or limited companies. Because if it is a limited company, then one source which is available, that is debenture. And we, I guess, discussed that as well, the debentures. Yes, an external source of finance last time. So it means limited companies have one more, in fact, they have lots of more options as far as raising finance is concerned. But one of the option which is available to limited companies, that is debentures. Partnership and not use debentures at all. Okay, it is not available to them. In fact, if I talk about long-term bank loan, even banks hesitate to lend the money because it is risky to lend money to sole trader and partnership because they might not be able to bear the loss and they may close down. So, but if I talk about sole trader and partnership, there is one option which is available to sole trader and partnership, but that is not available to limited companies. Do you know what is that option? The option which is available to sole trader and partnership, but it is not available to limited companies. Anyone?
Sir, selling shares on
No
stock
idea?
market.
No, this is the option which is available to limited companies and not to sole trader and partnership. I am saying the option which is available to sole trader and partnership, but not to limited companies. Nobody? Okay, all right. Listen, as soon as the session
Selling our own
expires,
assets.
selling our own assets. Okay, own assets. Okay, fine. All right. Not business assets. Owner's own assets. Okay, all right. As soon as the session expires, you need to rejoin it. Remember. Now listen, because in sole trader and partnership, one option which is there, that is personal savings. Owners, they use their personal savings to support a business. Remember. Why? Because sole trader and partnership, they are unincorporated businesses, and that means that business and owner are the same. So obviously the owners have to use their personal belongings as well, their personal savings as well, to save the business or to meet the responsibilities or liabilities of the business. Whereas in limited companies, because it is an incorporated business where business and owner are separate, so owners, they have nothing to do with the liabilities of the business. So they say, why would we pay? We have already invested money in the business, so our personal money is our money. We are not going to use it. And they are very right to say that. So that is why the option of personal saving or using the personal assets to support business or to raise finance is only available to partnership and sole trader businesses. Moving onwards, control. Now, sometime control means obviously when you manage a business. So when as a limited company you feel that if you sell more shares, you will lose control of the business. Like as an original owner, you are the original owner who started the company and you are the board of director as well, right? But you feel that if you issue more shares, more shareholders will come in and your shareholding power will go down. So does your voting power as well. So then maybe in the next annual general meeting you might not be able to become the board of director. If this is the fear there, then issue of shares option will not be used. Remember, because control will be lost by the original owners. Okay, so this is the only option which will not be used. Then they might be selling debentures rather than selling shares because they know that by selling debentures, ownership is not divided. But by selling shares, ownership is divided and they may lose the control of the business as well. Because generally in private limited company, shareholders are the board of directors as well. So they own the business and they control the business as well. So if they sell more shares, so they may lose the control of the business because now they may no longer remain the board of directors of the company. All right. Any question regarding these points which I covered regarding factors influencing the source of finance? I am there to answer. Any point which you are not able to develop. All right. No issues. All right. So I'm moving forward. Now, financial stakeholders. Stakeholders, you understand, right? So that is not a problem. Okay. Financial stakeholders means the people who provide money to business, and they are shareholders, banks, and creditors. Okay, why we are calling them stakeholders? Because stakeholders are the group of people who are directly affected by business activity and they have a direct interest in business. Okay, but when we talk about financial stakeholders, their only interest is to get their money back because they have given money to their to the business. Shareholders want their money as well as the profit which they earn. Banks obviously they want their money along with the interest rate, and creditors they want their money back at the right time. So they do have an interest in business, but that interest is finance, money. That is why we call them financial stakeholders, because they provide money to the business so that they can continue their business activity. Moving onwards, business plan, you understand this as well. It is a document. Okay, we are about to finish it. So today I'll finish this chapter, right? So please do join after if the session expires. So business plan is a document because not much slides are there. You can see that. Okay, only 2 3 slides are there, so I will be finishing it today.